All right, welcome to This Explainer. I want to kick things off right away with a pretty bold statement. Listen, having money isn't just about getting lucky. It really isn't. When you strip everything else away, wealth is just a game. It's literally a game of rules, habits, and math that absolutely anyone can learn how to play. So today, we're going to break down the mechanics of this game, drawing from some of the absolute best financial insights out there to show you how to progress from just, barely surviving all the way to truly mastering your wealth. So here's our level map for This Explainer. We'll start with level 1, the rules of the game, then move into level 2, your personal wealth playbook, and finally, level 3, mastering the market matrix.
Okay, let's dive into this. Level 1, the rules of the game. We are decoding the hidden forces.
Now, before you can start building real wealth, you've got to understand the hidden systems that are already acting on your money. Let's contrast two massive, unavoidable forces, taxes and inflation. So taxes are the visible cost of civilization, right? You flip burgers all month, your paycheck says $2,000, but your actual bank account only gets like $1,400. Federal, state, Medicare, Social Security, they all take a very visible chunk of your income, what you spend, and even what your investments earn while you're asleep. But then we have inflation. And inflation is a much sneakier opponent. It doesn't send you a bill in the mail. Instead, it's the slow, silent erosion of your money's value. It's kind of like opening a brand new bag of chips and realizing it's already half empty. Your $5 bill is still technically a $5 bill, but because there's too much money chasing too few goods in the economy, it simply buys less stuff.
And speaking of where you keep all that cash, let's talk about banks for a second. When you deposit money, you probably picture it sitting in this massive steel vault guarded by a dragon, right? Well, in reality, banks are really just middlemen. They operate on a concept called fractional reserve banking. So when you deposit $1,000, they might keep a tiny little fraction on hand and lend the other $900 out to someone buying, a jet ski. They make their money by charging that jet ski buyer a high interest rate while paying you a tiny fraction of interest for supplying the cash in the first place. But hey, don't worry too much. The system is designed so that in the US, your deposits are at least insured up to $250,000. Understanding these rules is absolutely crucial. Check out this massive number, $418,000. No way, right? But let's say your grandmother gives you and your brother $100,000 each to invest. Your brother finds a company charging a 1% fee. You, on the other hand, you don't really do the research, and you invest with a company charging a 2% fee. Now both of your accounts grow at the exact same rate. Fast forward 30 years. Because of that tiny, seemingly harmless 1% difference in fees, you end up with $418,000 less than your brother. It is just a shocking demonstration of how math is constantly working behind the scenes of your finances.
All right, let's level up. Level 2, your personal wealth playbook. We are shifting your mindset. So now that we know how the basic forces of money actually work, how do we use those rules to stop trading our precious time for a paycheck? Well, it starts with a fundamental mindset shift. You have to know the difference between an asset and a liability. I mean, it sounds simple, but most people fill their entire lives with liabilities, genuinely thinking they're assets. Here's the deal. An asset is simply something that puts money in your pocket. That's it. It could be a rental property, a piece of software code, or even a YouTube video that you make once but pays you ad revenue every single month. A liability, on the other hand, takes money out of your pocket. Think unused gym subscriptions or a really expensive car loan. The wealthy focus relentlessly on buying and building assets.
But you might be wondering, how do you actually free up the cash to buy those assets in the first place? You do it by using a conscious spending plan. I absolutely love this concept. Instead of some restrictive, boring budget that tells you to stop buying lattes, you automate your finances. You allocate 50% to your fixed costs, 15% to investments, and 15% to savings. And that leaves you with 20% for entirely guilt-free spending. The secret here is to cut costs mercilessly on the things you don't actually care about so you can spend extravagantly on the things you love. It completely removes the guilt and automates your wealth building while you sleep.
So why is that 15% investment category so incredibly critical? Let's look at 3 hypothetical investors, Billy, Susan, and Kim. They're all getting a 10% return. Kim invests a massive $117,000 over 39 years. Susan invests $24,000. But look at Billy. Billy only invests $15,000 for 5 short years, starting way back at age 15. Yet, at age 65, Billy wins. He completely crushes it, ending up with $1.6 million. This perfectly proves the time-bending math of compound interest.
It's not about how much you invest, it's about giving your money decades to literally clone itself.
But wait a second. As you start acquiring these assets, you're definitely going to hear the standard advice. Diversify, don't put all your eggs in one basket. Well, consider this advice from Andrew Carnegie instead. He said, put all your eggs in one basket and then watch that basket. When you are just starting out, diversifying is actually terrible advice. You don't get rich by doing 17 different things poorly. You get rich by obsessing over one skill, one business, one asset class, and hitting that first big milestone. You get rich by focusing, you stay rich by diversifying.
Okay, final stage. Level 3, mastering the market matrix. We're going inside quantitative finance.
We are zooming way out now, stepping into the highly advanced mathematical realm where Wall Street quants actually operate. Here's a crazy question for you. How do investors profit when markets fall? The traditional investor buys a stock and just kind of crosses their fingers and hopes it goes up. But the richest quants? They don't actually care if the market goes up or down. They are making money either way. The answer to that lies in the mechanics of something called short selling. I know it sounds completely backward, but here is exactly how it works. Step 1, you borrow shares you don't even own. Step 2, you sell them immediately for cold, hard cash. Step 3, you wait for the stock price to drop. And finally, step 4, you buy those exact same shares back at a cheaper price, return them to the original lender, and you pocket the difference. You are literally turning falling prices into calculated profit.
Quants will then take these concepts and combine them into what's called a pair trade. Imagine two companies, let's call them Alpha and Omega. The quants' computer models predict Alpha is going to do better than Omega over the next 3 months. So they short Omega, betting it will fall, and they go long on Alpha, betting it will rise. Now, let's say the whole market tanks and both stocks actually fall in price. Because Alpha fell by only 10%, but Omega fell by 12.5%, the quant still makes a profit. Price alone doesn't tell the whole story. What quants actually care about is the percent change in returns.
And how do they make these crazy predictions? Well, they definitely don't use gut feelings, and they aren't reading the morning news. They use the Quants Toolkit. If you map out the daily percent changes of a stock, it just looks completely jagged and random. But if you sort those daily returns into a histogram, magic happens. A bell curve appears. Quants map the market using these normal distributions. The center of the curve, the mean, is the expected return. How wide and spread out the curve is, that's the standard deviation, or the risk. They scale this massive puzzle across thousands of stocks using covariance matrices to find the absolutely perfect mathematical balance.
So, the ultimate difference really boils down to this. The traditional investor is out there hoping for the best, relying on their emotions and very basic diversification. But the quant investor, they have stripped human emotion out completely. They're using high-frequency algorithms, alternative data like mobile phone foot traffic, and mean variance optimization to literally hack the matrix. They find the hidden patterns, model the uncertainty, and execute thousands of trades in fractions of a second.
Wow, okay, we've covered incredible ground in this explainer today, from the silent theft of inflation to the time-bending power of compound interest, all the way up to the emotionless algorithms of quantitative finance. The rules of money are happening all around you, right now, whether you choose to participate or not. So I want to leave you with this final, most important thought. Which level of the game are you going to play today? Will you let the rules dictate your life, or will you use them to build your wealth? The choice is entirely yours. Keep learning, keep growing, and I'll see you in the next explainer.